Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael. In today's deep dive, we're going to look at Equinor. It's a Norwegian oil company, an integrated oil company, so an oil major that is doing everything from exploring to production and manufacturing oil and oil-related stuff. But as always, we will go through the 4, 5, 6 steps of a typical deep dive. So first we'll start with the screening process, how to actually find this company. And then we come to the technical analysis to see what are the trends for the company and for the overall market and perhaps other important variables that govern the company's actual fundamentals and profits. In this case, being an oil company, it's the price of oil and demand for oil and the general economy and how that relates to the oil price and the supply-demand balance for oil. And after that, we come to the meat of the deep dive, so to speak. It's the fundamental analysis and where we tease apart the development for profits, assets, sales, the book equity, things like that on the one hand, and on the other hand, how these are valued in terms of valuation multiples. And after the fundamental run-through and the P equals F times V research, then we make an estimate, this total return CAGR estimate, so the annual returns that we can expect from an investment in the stock Equinor. So this is the CAGR part of the deep dive. And finally, we'll finish off with an overview, putting Equinor into context with perhaps other similar investment opportunities. We will take a look at the risk of investing in Equinor. Remember that risk, when I talk about risk, I do not talk about stock price volatility, for example, but my main focus is on permanently lost ability to create cash flow for the company. Because as long as the company produces the cash flows that we expect, then sooner or later we will get those cash flows. It doesn't matter if the market actually keeps valuing these cash flows very lowly, because the lower the valuation of a certain amount of cash flow, the higher actually our returns. If you can toy with the idea that you have a company producing 100 in cash flow, and over time the company just becomes cheaper and cheaper and cheaper, and in the end you'll get it more or less for free, and then you own the entire company and you own that cash flow, and that has the real value of the sum of the cash flow that you own. So actually you shouldn't pay too much attention to the valuation multiples when you are looking at a really deep value fundamental case. On the other hand, the backside of that idea is the concept of a value trap. Things that look cheap can actually be cheap for a very good reason, and we'll take a look at that for Equinor as well toward the end. But for now, let's concentrate on the screening that I made to find Equinor. So first I used the free online resource Finviz, and I entered, I was looking for a low multiple investment. So here in the fundamental part of the filter settings, I used price earnings, a low price earnings, so below 15. As you can see, you can use any setting here, for example, below 10. Actually, you would still find Equinor if you used below 10, but I wanted to see what companies will turn up if I simply put in below 15, which is a typical benchmark of a cheap company. as long, of course, as it fulfills the requirements, other requirements of growth rates and risk. I also used a forward PE of below 15, just to make sure that last year wasn't just a one-off. I wanted the earnings per share to be pretty stable. I've also used sales growth for the past 5 years to be above 15% per year. That is a pretty steep requirement. Not many companies actually grow by 15% per year in terms of revenues. Perhaps a short comment here is that I'm pretty surprised that an oil company turned up in this search. I also used a return on equity requirement of above 15%. 15% isn't that high, an ROE for any company, and actually I think that should be the minimum requirement, at least if you pay 1 times book or slightly above. Because what you want when you invest in a single stock, assuming that idiosyncratic risk that you do when say investing in just one company rather than in a broad index, then you should demand a 15% return on your investment. And I put in more requirements here, more filter settings. I demanded an operating margin that should be high, so above 25%. That is pretty high for an operating margin. Many companies are operating in the 2 to 10% margin range. And about 25%, it's really just a way of making sure I don't get too many hits. I also used EPS growth the past 5 years of over 15% per year. So that was for the fundamental filter settings. I also used 2 descriptive settings. I wanted it to be a large company between $10 to $200 billion in market cap. Again, I could have used a lot of different settings here, but 10 to 200 billion is a nice one, and a dividend yield of above 4%. As you can tell, I'm kind of honing in here, I'm zooming in here on a deep value company with high cash flow, good dividends, that is stable, but also has been growing pretty decently over the last 5 years. And here is what turned up. I'm not sure why XP Inc. Appears here with a PE of 12, because I used below 15. So these 3 companies, Equinor, Banco Bilbao, and XP, turns up in this screen. A snapshot of Equinor shows, well, you can see it here if you just click Equinor in Finviz, you'll get a nice chart, and below it you'll have all the key ratios you'll ever need. And here you can see the PE of 7.5, forward PE of 7.6. You have the dividend ratio somewhere here, and a price-free cash flow of 8.7. So you can just go through all these numbers, and you can tell that this is an interesting company. Yeah, here you have the dividend of the trailing 12 months was 1.4, and the estimated dividend is 1.5. What you can also do here is compare Equinor to a lot of other integrated oil companies in terms of PE. You simply use a screen for integrated oil majors and sort it on low PE, and you see Ecopetrol and Equinor at the second place at 7.5, pretty good. You can also sort, for example, on performance for the last quarter, and here, well, most of them have a negative performance, but Equinor is just above the zero threshold for that time. So next up, the technical analysis.